Okay, let's get the party started. Welcome everybody to the Traction webinar. Today's Tuesday, August the 27th. We have a fantastic guest today. We have a fantastic topic. It's a topic that every single investor needs to know. They at least understand the concept. If you're a beginner, you need to understand how this works. If you are intermediate of advanced, maybe you have done it, maybe you have not. This is a fantastic tool that we all need to know. 1031s. So I'm going to share just a few things about Traction, and then I'm going to give David all the power to share his fantastic information. Okay, so welcome to Traction. We are a very proud chapter of the National Real Estate Investors Association. And this is me. It's pronounced Carolina, but if you call me Carolina, Caroline, don't worry, I won't be offended, but it's Carolina. I'm Vice President of the Traction Real Estate Association. We are the official chapter for the DC metro area. That includes Northern Virginia and Southern Maryland. And we also have a beautiful chapter in the Tampa, Sarasota area in West Florida. So we are very happy to have those two fantastic chapters. I'm just gonna tell you right out the start, right? But don't worry, don't be afraid. This is just a very simple disclaimer. We're gonna talk about money. We're gonna talk about real estate. All we ask you is that just please be an adult, do your own due diligence, and learn from the best. Get all the information that you need so you don't make mistakes. That's it. That wasn't too tough, right? Yeah, that was simple. We always ask you to please share with other people that maybe they don't know that we exist, that this is a fantastic community where you can share, you can network, you can learn, you can meet fantastic people, do deals. So we always ask you to tell other people, hey, tell them about Traction and all the events that we do in person and online. We also have a great Facebook group. Make sure you join that. We post really cool videos, updates on what's going on in Traction and also in the industry. So make sure you join that. Also, we have a great podcast by my very handsome husband, Tom ZEEB. It's all about real estate negotiation. So take a look at that one. You can listen to it anywhere. If you haven't, make sure you have the Traction app in your phone. It will keep you updated on events, on in-person and online. We have really cool video trainings as well. So it's a really cool tool for you to have. I always want to remind our attendees, some of you, maybe this is the first time you're joining one of our events, that as a member of Traction Real Estate, we have a fantastic partnership with the Home Depot. They give us 20% of liquid paint, discounts in cabinets, a beautiful 2% cash back on everything that you buy at the Home Depot. And in general, they're going to look at you different because we have a fantastic partnership. So that's one of our biggest benefits in terms of discounts and rebates with the Home Depot. If you're not a member yet, all the information is on our website, tractionrea.com. Join. We have an individual membership price, we have couples, and we also have a special rate for business. A few upcoming events that we have in person in DC. I will be there September 19th. We do a really cool beer and real estate. We hang out, we drink beer, we talk about real estate. So there's nothing really bad about that. That's September 19th in Fairfax. And then in the Sarasota area, we have an in-person meeting October the 8th. I asked an insurance consumer advocate to come and tell us everything that is going on in Florida and everything that is related to Florida and how we can make better decisions and the right decisions when it comes to insurance in Florida. And I think that's it for me in terms of sharing what's going on in Traction. I'm going to stop sharing and then I'm going to invite Dave to join me. Hello, David. How are you doing?
I'm well, Carolina. How are you?
Good. We're very happy to have you here. I've been telling our members and our attendees that 1031, it's a tool that they all need to know because it's at some point in your real estate investing life, you will use it. It's a fantastic tool that will help you save so much money in taxes, increasing your profits, so investment properties that you have. So I want our attendees to know that you know your stuff. You are fantastic. This is what you do, and that you're gonna teach us the concept, how to use it, and what will be the best way for people to work with you to make it happen. And also, you mentioned that for Traction RIA members, you also give them extra love. There are discounts included, so that's good to know. And then we will be talking about questions and answers. What we normally do, David, is I let you do your presentation, and then whenever you think that is a good break, we can do Q&A or at the very end. Will that be okay?
Sounds good to me, and I think we'll probably
Awesome.
take a few breaks along the way to answer some questions.
Awesome. I'll be keeping an eye on the chat, and what I ask you attendees is just hold off your questions. Let's focus on David's presentation, and then at the end I'm sure some of your questions will be answered throughout the presentation. If you can turn on your camera, that will be lovely. We can see your lovely faces. And then I think that's it, David. They are all yours.
Thank you very much, Carolina. I'm looking forward to seeing you in a few weeks in Fairfax. Okay, let me share my screen. Let me make sure I share the correct screen. Now you should be seeing a slide presentation, and I'm going to move this over here so I can see you folks. The benefit of having multiple screens. Okay, so we're going to talk about 1031 exchanges tonight. There we go. And bear with me, I'm going to apologize in advance. I had a pretty bad cold over the weekend. It doesn't want to let go, so if I cough or sneeze along the way, I'm apologizing now in advance. Okay, so let's jump right in. This is about me. This is how you can contact me. Just a little bit about me. I am a past president of our National Trade Association, the Federation of Exchange Accommodators. I'm also on our ethics committee. I'm a past board member of the local Realtor Association. In my family, I'm actually a third generation real estate investor. I can trace my real estate investing back to my grandparents. And I'm also a part-time volunteer EMT. So I promise if you fall down in front of me, unless it's unsafe, I will do my best to help you. Carolina mentioned some extra love for RIA members. If you are a member of RIA and you want to structure a 1031 exchange, I will offer you a 10% discount on our fees. You have to tell me that you're a member. I don't have access to every member list for every RIA in the country. And then I will reach out to Carolina and Tom to verify that you're a member. Yes, I trust you, but trust and verify. So you tell me, I'll verify, you'll get a discount, and I'll show you exactly what the price would have been, exactly what the price is, and it's not a bait and switch. It really is a real discount. Okay, we're going to talk about the who, what, when, where, why, how, all that you need to know about 1031 exchange. I'm going to cram 6 hours of legal education into 90 minutes. So hold on, buckle your seatbelts. It's going to be a fast ride. We're going to start with our client. Our hypothetical client is Harry. He's young. He's a single guy, college graduate with an engineering degree. He's making $75,000, and he's a smart guy. He's living at home with his parents and his dog, so he's saving some money. And he's decided he wants to buy his first investment property. He's buying Pennsylvania Avenue. It's a single family rental. He's going to pay $100,000 in cash, $220,000 mortgage, $320,000 total purchase price. So far, so good. I shouldn't be losing anybody yet. Okay, keep that in mind. And I'm starting with Pennsylvania Avenue because if we want to simplify 1031 exchange to its absolute bare bones, it is playing monopoly with real properties and real money and deferring the capital gains tax when you sell Pennsylvania Avenue to buy Boardwalk. So Harry is buying Pennsylvania Avenue to get started. Now, along the way, Harry's going to have to pay taxes. And one of the things that Harry has to recognize is that taxes apply to every dollar you earn, every dollar you bring in, regardless of their source, even illegal income, such as embezzled funds, or you're selling drugs or booze or whatever. In fact, this is what I call the Al Capone clause, right? They never proved that he was selling the guns and the booze and the whatever, but they did get him on tax evasion. So you have to report all of your income. Okay. If you want to not pay tax on some of that income, the burden shifts to you to prove why you shouldn't have to pay tax on that income. And that's where Section 1031 comes in. Section 1031 is a place to shelter gain on investment property. It's actually gain on investment real estate only. It used to apply to any business or investment asset. It now only applies to business or investment real estate. And what the statute says is that if you have one piece of business or investment real estate and you structure the transaction correctly and you buy new business or investment real estate with the proceeds, you do not have to pay the capital gains tax currently. It's actually a tax deferral strategy. You're kicking the can down the road. However, if as part of your investment strategy, you're willing to do one very important thing, you can make this a tax-free transaction. You have to be willing to die as part of your planning. Because if you die as part of your planning and you still hold all of your assets, your heirs, at least under the current tax regime, your heirs will inherit those assets at the fair market value as of the date of your death. Now, let's take dying out of the equation for a moment, and let's assume that you, excuse me, do a 1031 exchange today, and then in 10 years you decide to sell that asset. Let me ask you this, it's rhetorical, I know you know the answer. Would you rather pay me $100 in 10 years, or would you rather pay me $100 today? Of course you'd rather pay me in 10 years. That's the time value of money. So even if you ultimately end up paying the same amount in taxes in 10 years or 20 years, whatever it is, it's discounted money. It's not worth then, it's not worth in 10 years or 20 years what it's worth today. So even if all you ever do is defer these taxes until some later point in your life, you're still making out very well. Okay, now let's talk about what kind of assets work for Section 1031. The statute says that the real estate must be held for productive use in a trade or business or investment. Here are three very simple examples. Raw land, a multifamily building, an industrial building, those all qualify. Bottom line, business or investment real estate. What doesn't qualify, well, we'll talk about what doesn't qualify in a minute. Some other things that qualify beyond just these three examples would be mixed property. That picture on the top is a multi-unit building, 3 stories, 3 properties wide, 9 units. If I live in one of those 9 units, I can do a 1031 exchange on the other 8, but not on the unit that I live in. Similarly, this picture at the bottom is a transaction I had last year. It's a horse farm. The family owned 35 acres, including the 1 acre where their house sits. Well, they sold that property, the entire thing. We did a 1031 exchange on the 34-acre horse farm, but not on the 1 acre homestead. So that qualifies, the investment portion of the asset. What doesn't qualify is primary residences, second homes, vacation homes, and fix and flips. If you're buying a property to turn it around and make it nicer and then resell it, that doesn't count. If you're buying a property and your plan is to rent it out for 6 months or a year and then move in, that doesn't count. Your plan must be to treat the property as an investment property. You will ask me for how long, and I will tell you that your plan should be that you will hold it that way in perpetuity. Your plans can change based on external factors, But how long you hold it alone is not going to answer the question. It's how you treat the property, what your plans were. And by the way, if the IRS disagrees with how you treated the property for tax purposes, they have subpoena power. They can subpoena all kinds of records to prove that you're trying to pull one over on them. You don't want to be there. Okay, so Harry bought Pennsylvania Avenue a while ago. He's using this property as an investment property. Now he meets Sally. And Sally has a cat, and they get married and they move in together. Wonderful. So what does this tell us? Well, I will tell you that from my experience, Sally is going to want to participate in all of Harry's investment decisions. She may want to join him in the business, like Tom and Carolina have this wonderful business going on. I know they invest well together. They run Traction Rio well together. Harry and Sally may run their real estate investment business together. In fact, many people I know in the RIAs around the country operate as a spousal team. Now that Harry's starting to think about selling Pennsylvania Avenue, so why might somebody want to structure a 1031 exchange with their assets? Well, you could simply say they want to structure a 1031 exchange so that they don't have to pay taxes. Except if you don't sell the property, you don't have to pay taxes. So what other reasons might there be that motivate Harry to sell the property? Well, perhaps he wants to take advantage of some of the equity that he's built up in Pennsylvania Avenue and leverage that new equity into bigger assets. Perhaps he wants to relocate to the other side of the county, or he wants to move from Fairfax, Virginia to Sarasota, Florida, or from Seattle, Washington to Boise, Idaho. Doesn't matter. Anywhere within the continental United States, anywhere including the 50 United States, the District of Columbia, Guam, the Mariana Islands, and the U.S. Virgin Islands. All of that is like kind to each other. So I can sell in any one of those locations and buy in any of the others. A footnote, Section 1031 also works for foreign investors in U.S. property. So over the years, I've worked with investors from the UK, from half of Europe, from some countries in South America, from Asia. All of those folks who own U.S. property are now subject to U.S. income tax, and Section 1031 will help them when they want to sell investment property number one to buy investment property number two. It would also work if I own investment property outside the country. It's not going to help me with my foreign tax issues, but it will help me with my U.S. tax issues. So if I have property in the UK and I'm tired of being in the UK, I want to be in Belize, well, I can do that. So I can sell my UK investment property as a properly structured 1031 exchange, not pay the capital gains taxes, and reinvest in Belize, and that's okay too. But I can't sell the UK and come to the US. Okay. I may also be structuring, or Harry may also think about using 1031 exchange as part of an estate plan. So if we fast forward a bunch of years and Harry and Sally have 4 children, it may be they may decide that, you know what, we have this wonderful apartment building in Fairfax, Virginia, and we don't want 4 children to inherit one building. They might not agree on how to run it. So perhaps we should sell that one large building and buy 4 smaller ones. And we've had many transactions over the years where folks do that. So any external reason that motivates somebody to sell a piece of investment property would be a wonderful opportunity to start thinking about the 1031 exchange as part of the strategy. It never hurts to think about 1031 exchange, even if you're not certain you'll complete the 1031 exchange. Over the years, I've seen some people start a 1031 exchange and then intentionally decide not to reinvest. Well, that's okay. You can do that. But if you sell your relinquished property without starting a 1031 exchange before you get to closing, you can't change your mind in a couple of weeks and say, you know what, I want to do a 1031 exchange. So you have to set this up before you get to closing on that first property. And when you set it up as a 1031 exchange, you're essentially buying yourself an option to complete a 1031 exchange. And if you choose not to exercise that option, there's no penalty, there's no interest, your taxes haven't come due yet. You're out the $1,000 or $2,000, whatever it is in exchange fees. Those are business expenses, not a horrible thing. So it's always a good idea to default to setting up a 1031 exchange rather than not setting up the 1031 exchange. Okay, so back to Harry and Sally. Harry and Sally are relocating. They're relocating. I'm going to keep picking on Carolina. They're going to relocate from Fairfax, Virginia to the Sarasota, Florida area because Sally is tired of the DC winters. Not that they're horribly cold like they might be in Montana, but Sarasota winters are definitely more palatable than DC winters. So they're relocating, which means Harry wants to take his investment property with him. He can't simply pick up Pennsylvania Avenue and carry it all the way down to Sarasota, so he's going to sell it. Fortunately for Harry, he now has a contract that says that he will receive $600,000. Fantastic, $280,000 in profit. But wait, let's do some math. So Harry bought the property originally for $320,000. He made some improvements, and he has some expenses when he sells the property. So his total gain in this property will be $215,000. So it's $320,000 plus $25,000, and the $40,000 and $600,000 nets that out to $215,000 in capital gain. He also owned the property for about 5 years, so he took $58,000 in depreciation. What's his tax going to be? Well, Harry's probably in the 15% tax bracket as far as the feds are concerned, so there's $32,000 there. Depreciation recapture is 25% of the $58,000. His state level tax is 3.99. State level taxes range from about 3.5 to 13.3%. There are a handful of states that do not charge a state level income tax. If you live in one of those states, God bless you. But if you don't live in one of those states, you're going to have to add that in as well. And then Harry is fortunate enough to have over $250,000 in net investment income. So he also has 3.8% Obamacare tax, or the Medicare surcharges, it's all called. The total tax bite to Harry, if he sells this property outright, will be $63,500. That's 30%. It's just shy of 30% of his profits. And in fact, historically, I tell people, if you want to estimate what your tax bite will be, absent the 1031 exchange, 30% is a good number to estimate. It might be up or down by a point or two, but that's a good place to start. Okay, so if Harry structures this transaction as a 1031 exchange versus without a 1031 exchange, what's going to happen? Well, the right-hand column is no 1031 exchange, and after all of the expenses and all of the taxes, Harry walks away with $496,000. Excuse me. If Harry does structure the 1031 exchange, he only has to pay the $40,000 in selling expenses. That's brokerage commissions and transfer taxes and such like that. He'll have $560,000. That $63,000 difference can be huge. That's $63,000 of additional equity. And if he's getting leverage on his new property, that $63,000 could easily be the difference between a $500,000, well, a $600,000 property and a $750,000 property, or actually a $750,000 and a $900,000 property. So it's important to at least consider 1031 exchange. Now, here's where somebody's going to say, David, that's wonderful. Harry's going to save $63,000, but what's this going to cost? On average, a transaction like this would cost somebody about $1,300. Excuse me. Traction RIA members would save $130 on that. So you're looking at about $1,170. $1,100 to save $6,300. If I could put down $1,100 in the morning and pick up $63,000 in the afternoon, I would do that every day of the week for the rest of my life, and I could retire very happily. Okay, I keep putting my water bottle down in front of my clicker. Now, just real quick, this is the current long-term capital gains brackets. There's a proposal in Washington from, well, President Biden's 2025 budget, as well as the DNC's platform for 2025 and beyond, is talking about, excuse me, an additional bracket above the 20% for people whose joint income is over, I think, $1 million or $2 million. So it may or may not apply to you. I apologize, my throat is killing me. But there is this additional tax bracket that's possible. So 15% or 20% for most tax brackets. I mentioned that the state level taxes vary around the country. California's 13.3%. I'm in New Jersey. 10.75% is the top tax bracket. Virginia's 5 3/4. Here we go, 29.55% for somebody in the top tax bracket. Again, like I said, estimate 30%. So what does Section 1031 help us do? Section 1031 will help us defer 4 different layers of taxes. The federal capital gains of either 15 or 20%, the depreciation recapture of 25%, the state level taxes of up to 13.3, and then the net investment income of 3.8, if it's applicable to that investor. It's probably applicable to almost every one of us if we're selling an investment property. So how do we avoid paying those taxes? We structure a 1031 exchange. And how do you do that? Well, the first thing you have to do is choose a qualified intermediary. I don't want this to be a commercial for me, but it will be a little bit. If you don't choose me as your qualified intermediary, that's okay, but I at least want you to choose someone who's qualified. I am not saying that I'm the only qualified intermediary, the only qualified intermediary. There are others, but I want you to ensure that you choose properly. Don't hire someone just because your mother's brother said that they're a good person, or your bowling buddy said that he's a good. Check out their credentials. How many attorneys do they have on staff? Are those attorneys available for consultations if there's a complex issue that arises? What kind of banking processes do they have? What security do they have involved? Are they insured? Are they bonded? Are they members of the Federation of Exchange Accommodators? Again, that's our industry trade association. You probably wouldn't hire a real estate agent who wasn't a member of the National Association of Realtors. You probably wouldn't choose a doctor who wasn't board certified. Certified exchange specialists are also important. I will tell you that our firm has 5 full-time staff attorneys. We are available for consultations. You know, getting sick is not a good thing. And I apologize. We are available for consultations. We have a $50 million fidelity bond, a $25 million E&O policy, and a $20 million cyber liability policy, because everything we do is online in patented software that, if any of you is a computer nerd, has SOC 2 compliance certification. So our software passes the same rigid security protocols that bank software does. Okay, moving on. Some people who cannot be your qualified attorney, qualified intermediary, your attorney, your employee. So Carolina's bookkeeper cannot also become her qualified intermediary overnight. Your accountant, your real estate agent, your investment banker, your broker, your relatives, these people cannot be your qualified intermediary. You need to choose someone who is qualified. And again, don't settle on somebody just because they're not disqualified. I have served as an expert witness in cases where the taxpayer chose somebody just because they were convenient without checking out their credentials. And then you come to find out that the documentation was defective and there wasn't a valid 1031 exchange. Carolina, let me pause for a moment. You can see if there are questions, and I'm going to put a cough drop in my mouth.
Sure, it's okay. You keep saying if you're moving from Virginia to Florida, that's exactly what happened, and that's what we did. We had a rental property in DC, and we were getting rid of it, and then I didn't want to pay those taxes, so then I just set up the 1031, and that's it. What you said is important that you choose the right one, so they can walk you through the exact process, all the steps that you have to do, and then avoid any issues later. So again, it's just a beautiful, beautiful strategy. And I'm sure you're gonna tell them how you identify the properties, how the whole process goes. But if you have someone that is leading you and telling you exactly the steps, then you're gonna be totally fine.
That's exactly where we're going next.
Great.
So, moving on. When we start the process of a 1031 exchange, negotiating the sale of your original property should not give you any stress. At the beginning of the sale, it's business as usual. There's nothing different at the sale, certainly not in the negotiation part, that's any different from any other transaction. I will tell you that if you use standard realtor form contracts, this one happens to be from Ohio. Many standard realtor form contracts have provisions in there that it can't be assigned or those kinds of things. It's a good idea to either X that out, or I know Florida actually has a checkbox. May be assigned, may not be assigned, may be assigned, but not the rights. The responsibilities may be assigned, but not the rights. And the other was, everything can be assigned. Whatever it is, make sure you confer with the qualified intermediary, check the correct box, or X that out completely. And all of these contracts have a paragraph near the end where you can type in additional terms and have your broker type in, seller may assign its rights under this contract, but not its responsibilities to accrue it as qualified intermediary as part of a Section 1031 tax deferred exchange at no additional cost or obligation to buyer. It's not mandatory. It's good form. It's not a bad idea to get that other party involved and give them notice early on. When you get your contract, when you get your property under contract, that's a great time to hire the qualified intermediary. People often ask me, what is the best time? Candidly, I would prefer you call me before you even call the real estate broker so that I can educate you before you get into the process. But when you get a contract on that property is an absolutely ideal time to get us involved. But you must get us involved before you get to the closing table. Once you get to the closing table, the game is over if you don't have a qualified intermediary involved. If closing was Monday and today's now Tuesday, I can't help you fix yesterday. I can help you fix tomorrow, but I can't help you fix yesterday. So hire the qualified intermediary early. Now, when we get to the closing table, the deed will go from Harry directly to the buyer. Nothing here has changed so far. The change happens in that the money will not go to Harry. It will come to me to hold in escrow on Harry's behalf. Fully segregated bank account. Harry's money never touches any other person's money. It's not going to touch Carolina's money or Russ's money or Jacob's money, anybody else's money. Harry's money will be safe. Now, we've said that Harry sold that property for $600,000. I told you that there were $40,000 in expenses. Those expenses reduce what Harry has to reinvest. However, the IRS hasn't told us which expenses those will be. So an awful lot of attorneys around the country have come to the conclusion, until we get guidance from the IRS, that transaction costs that absolutely have to occur as part of the transaction would be allowable as far as what's going to reduce what Harry needs to reinvest. So the brokerage commissions or a consulting fee to somebody who helped me find the sell the property. If I have to pay title insurance premiums as seller, if Harry has to pay the title insurance premiums. In some states, seller provides title insurance. In most states, buyer buys their own. If I have to pay closing agent fees, title fees, escrow fees, documentation fees, tax stamps, attorney's fees, all of those expenses that occur specifically because of the transaction, those are eligible to help reduce Harry's expenses. Similarly, those expenses could be added to the purchase price. So if Harry finds a property for $550 and has an additional $40,000 in expenses, it becomes $590. Expenses that do not offset Harry's obligations would be prorated rents, security deposits, credits for fuel in the tank, unpaid HOA fees, unpaid taxes. All of those other items are actually business expenses that Harry should have paid. Somebody might say, well, yeah, but David, the buyer got a home inspection and it said I needed to repair the roof, so I had to pay $5,000 to a roofer. I wouldn't have paid that $5,000 if I wasn't selling the property. Well, that's still called deferred maintenance. You should have been doing that maintenance. That you chose not to pay it today, that's on you. It's not a transaction cost. So on our example, we're going to move forward. Harry's property closes on November 15th of this year. I chose that date on purpose. You'll see why in a minute. For total tax deferral, Harry needs to do two things. He needs to trade equal or up in adjusted value. So in Harry's case, it was 600 minus the 40, so 560. And he needs to trade equal or up in equity. Now, we didn't talk anything about a mortgage payoff. If Harry sold it for 600 and he had to pay off $100,000 in debt, his 560 just became 460. He only has 460,000 in cash. Here's a simple example. Harry finds a new property that he wants to buy for, he's selling for 560. He finds a property he wants to buy for $800,000. His lender says, oh, Harry, you've got good credit. We'll lend you 50%, $400,000. Harry says, that's wonderful. He writes a check for he has the intermediary send the other $400,000, and now he owns the new property. $800,000 is more expensive than the 560 that he sold, except he had 460 at the 1031 exchange. And the 60 that he did not reinvest just became a taxable event. So it's important that Harry knows, and this is why I like to talk to you early, that Harry knows that he needs to trade equal or up in fair market value and equal or up in equity. And if we talk Harry about this early enough, he can go back to the lender and say, yeah, you know what? I appreciate that you're willing to lend me 400, but can you reduce that down to 340 so that I can bring my whole 460? And if you tell the lender early enough, they'll do that. But if you tell them the day before closing, they won't. Okay. Now, if Harry trades down, so if he sold for 600, nets down to 560, and he buys a property for 500, he's only naked on the difference, the $60,000 difference. It's not that he loses his entire transaction, but he's exposed on that $60,000. Might there be other things going on in Harry's background that allow his CPA to offset Some of that 60,000, perhaps, but that's not anything I can help with. Okay, now 1031 exchanges bring with them time limits. In 1984, Congress amended the statute to impose a 45-day identification period. We'll talk about what that means in a minute. And a 180-day exchange period. And actually, the statute says 180 days or the due date of your tax return, whichever is earlier. Now, remember I said Harry's property closed on November 15th? November to December, January, February, March, April, May 15th would be ish. Oh, this brings up a good point. It's 180 days. It's not 6 months. I just estimated for the purpose of this conversation, but it's 180 days, not 6 months. Don't get caught up in that. So 180 days for Harry will take him to the middle of May. His tax return was due April 15th. So he can file for an extension on his tax return to get the full 180 days, or he can complete the exchange before the tax return is due. Note that these are calendar days, not business days. The IRS does not care about Christmas, Kwanzaa, Ramadan, Diwali, none of that. If your cat had puppies, the IRS doesn't care about that. It's 45 calendar days, 180 calendar days. If that deadline falls on the weekend, then you need to complete the task by Friday. Okay. Now, you cannot request an extension on these deadlines. It's just not going to happen. There are, however, 2 exceptions. Both of these are beyond your control. If you are in the middle of a 1031 exchange and you get deployed to a combat zone as active military, then you're entitled to an extension. If you are in the middle of a 1031 exchange and there's a presidential disaster declaration, think Hurricane Katrina, Debbie that just came up the East Coast a couple of weeks ago, those kinds of things will give rise to a presidential declaration, and the IRS will determine whether you get an additional postponement. The IRS is surgical, if I can use that term, in giving out extensions. For example, they won't say it's all of Georgia. They may say it's these 17 counties because the other counties didn't have a whole lot of impact. So don't count on an extension. Count on the 45 days and the 180 days. Now, what does it mean to identify? You have to submit a written document to the qualified intermediary by midnight of the 45th day. Now, we have people on this call from all around the country, so your question might be, okay, David, you're sitting in New Jersey, your company's headquartered in Colorado, and I'm sitting here in Los Angeles. What time zone do I use? We are of the belief that the time zone applies to where the taxpayer resides. So you're not going to be penalized because you chose me in New Jersey if you live in California or Hawaii. How do you identify? Well, easy way is to give me the street address in writing, signed, send it to me. If the property doesn't have a street address, you can give me a legal description or a tax ID number or parcel ID number. Or if the property has a distinguishable name, the regulations give the example of the Mayfair apartment building. A mile or so away from me here is the Johnson Farm, right? I can't tell you what the street address is of the Johnson Farm, but I can get you there. And that's the point. Can a reasonable person in the community find the property that you've just identified? If you say, oh, a condo unit in the Dolphin View Towers in Sarasota, Florida. Well, the Dolphin View Towers is 30 stories tall and there are 10 units on a floor. That's 300 units. Which one did you identify? You need to be able to verify which one you identified, not just a unit. A couple of other things that are important to keep in mind with regard to identification. And I added this slide in the last year or so because a lot of taxpayers apparently didn't get the memo. You can buy property with other people. So Juan and I can go out and buy a property together. Perhaps we're going to invest 50-50, or maybe he has more money than I do and it's going to be 2/3, 1/3. That's okay. But if I'm buying that property as my replacement property in my 1031 exchange, I need to identify that I'm buying a 1/3 interest in that property. Because if I simply write down 123 Main Street and then at closing, I only bought a 1/3 interest, I didn't buy what I said I was going to buy, at least not according to the IRS. If you identify more than one property, and we're going to talk about that in a moment, if you identify more than one property, then it's prudent that you tell me how many of those properties you plan to actually acquire. Now, I talked about grandpa and I talked about myself having 4 children and wanting to buy multiple properties for the 4 children. Well, if I identify 4 properties, I don't want to buy all 4 properties, that's fine. But if I identify 4 and I only wanted to buy 3, I should tell the qualified intermediary. And that's because the qualified intermediary cannot release the money in their account if there's any excess until you have acquired everything you said you were going to buy. So if I sold $1 million, I identified 4, I said I'm going to buy 3, and at the end of the day, there was still $10,000 left. Well, once I bought those 3, I can have that money. But if I didn't say I was only going to buy 3 and we're only at day 150, the intermediary needs to hold the money until day 181. Along those lines, during the first 45 days, if you change your mind, we cannot release the money to you until we get to day 46. IRS regulations prohibit us from releasing the money during those first 45 days. Okay. Moving along. So let's talk about how many properties you can identify. There are 3 very simple rules. You only need to follow one of them. Start at the top of the page and move on. You can identify up to 3 properties, no further questions with regard to fair market value. That's fine. 98% of my clients use the 3 property rule. You can choose to identify more than 3 properties. That's okay too. But if you do that, then the total value of everything on your list should not be more than double the value of what you sold. And why would they do that? Because they don't want you to write to sell one property and then tear out a page from the phone book. All right, there are no phone books anymore. But to then say, I'm going to, you drive down the street the next block up from me is about a half a mile long. There are probably 50 or so homes on that half mile. I could drive up and down that street and write down every one of those street addresses and say, yep, that's my identification. I'm not planning on buying all 50 of those properties, and that's what the IRS wants. The IRS's theory here is that you should know what you're doing before you should know where you're going before you leave where you're at. Don't back yourself into a corner. If you happen to identify more than 3 properties and then the total value of that list is more than double the value of what you sold, you need to buy 95% of that identified value. I will tell you, our staff watches those identification notices very carefully. We love it when you call us on day 40 and say, this is what I'm thinking. What we don't like is if day 45 is on a Saturday and we haven't heard from you in that whole week leading up to Saturday, and then on Monday we come in and there's a notice that has some defects on it. I can't help you fix the defects. So communication is a 2-way street. We will do our best. We hope that you will do so as well. Now, what is like kind? Well, here's this wonderful view of Sarasota, Florida. I can't see Carolina in there, but I know she's there someplace. Those boats are not like kind real estate. But anything... No, I mean in the picture in the middle of the slide.
Oh, yeah.
Yeah, there's Carolina. Yeah. I know she's in that picture someplace, but I can't find you.
You're saying that I cannot 1031 my jet skis? Man, I just got 2
you can't 1031 your jet skis, but any other piece of real estate in that picture is like kind to any other, there are a total of 7 pictures there, right? So I could sell a unit in one of those condos and I could buy the raw land or the duplex or the ski slope or the single. It's all like kind. Real estate is real estate is real estate. Don't worry about asset class. I can't tell you how many times in a year we hear, I'm selling a condo. I don't want to buy another condo. I'm selling a duplex. I don't want to buy another. Don't. You don't have to. All of that is like kind. Okay, so keep an open mind. Ask us lots of questions. Believe me, we would much rather answer 1,000 questions that you think are silly than to find out you didn't ask the very, very most important one that made the difference between pass and fail on your 1031 exchange. Okay. I mentioned earlier putting a line in the contract about people cooperating with another. Here's just another version of that. Now, when we go to purchase the property, same as before, keep calm. It's the same basic transaction. Probably a good idea to put a comment in there that you're buying this property as part of your 1031 exchange. When we go to closing, we are sending money to the closing table on your behalf. The seller will now provide the deed. Look at that. Harry's buying Boardwalk. He sold Pennsylvania Avenue to upgrade to Boardwalk. We provided the cash. Harry gets the deed. And this is what the 1031 exchange looked like. Okay. Harry provided the deed to the buyer. The cash came to us to hold on his behalf. We sent the cash to the seller. The seller gave Harry the deed. That's a 1031 exchange. If you are taking screenshots of any of what we're talking about tonight, this is a slide to take a screenshot of. This is everything you need to know about 1031 exchange in one slide. If you want to fully defer all of the taxes, you should do what's on this page. You should receive nothing other than like-kind property. So if I sell my Virginia investment property, if I'm gonna follow Carolina and Tom for a minute. I'm gonna sell my Virginia property. I'm gonna buy a property in Sarasota, and the one in Sarasota includes 2 jet skis. I have to back the value of those 2 jet skis out of my purchase because they're not real estate. So if I sold $1 million investment property in Virginia and I bought $1 million investment property in Sarasota that included 2 jet skis, I have to back out the value of those jet skis. They are not real estate. Okay. I want to make sure that I adhere to both the 45-day identification and 180-day exchange limits. I want to make sure that my replacement property is equal or greater in value than my relinquished property, and that I reinvest all of the equity. And I can bring more equity, that's fine too. I can bring more cash to the closing table, but I want to make sure that I reinvest all of the equity in that new property. Oh my goodness. If there was debt on the old property, I can replace the debt with new debt, or I can replace the debt with cash. Okay. Oh my goodness. I'm going to go to bed as soon as we're done tonight. I am so sorry I'm coughing in your ears. Okay. And I need to ensure that I avoid even constructive receipt of the 1031 exchange money, meaning I need to have the qualified intermediary as part of my team before we get to the closing table. So that's the basics. I'm going to stop here at the basics for a moment to see if we have some questions before we start getting into some of the nitty-gritty stuff.
Yeah, we have 2 questions from, the first one was from Jay, if he wants to know if 1031 applies in Canada. I don't know if you answered that or not.
I did, but I'll touch on it again real briefly. If I'm a U.S. taxpayer and I'm investing in Canada, I can certainly use 1031 exchange to defer my U.S. taxes. It does not do anything with my Canadian taxes.
Awesome.
When I'm a Canadian citizen investing in the United States, U.S. taxes will apply to me, but it's not, again, it's not going to do anything for my Canadian taxes.
Okay. Hannah was asking, I have a single family and small multi-family rentals that I'd like to exchange for something that is far more passive. Would a syndicate qualify as a like-kind exchange?
Good question. We're actually going to talk about something like this in just a couple of minutes, but the short answer is most syndications will not qualify because of the way they are structured. If they are structured as tenants in common or Delaware statutory trusts, they will. But most of the syndications that I see are structured as limited partnerships, and you come in as a limited partner and I'm the general partner and you just watch me manage your money. That doesn't count. You need to have a deeded interest in the property. A Delaware statutory trust is an exception to that rule, but you need to have a true deeded interest in the real estate.
Okay, Donna was asking, can a STR fund be considered as an investment to 1031 exchange into, or does it not qualify as real estate?
Oh, what kind of fund?
STR. And Donna, feel free to unmute.
Short-term rental.
Go ahead.
Short-term rental. Oh. Yeah, when you use it in context, like now I understand what you mean by short-term. So a short-term rental property qualifies. If you own a fund, that does not. So again, you need to actually own the real estate. You can't participate in a fund or a syndication. When I buy my replacement properties, it can be short-term rentals, long-term rentals. It can be raw land that is developing, that is generating zero income. I know a gentleman who owns several thousand acres of land down in Mississippi, and he bought it hoping that one day the state wants to buy it from him.
Okay, the next question is, Salamawit is asking, does this 1031 apply to fix and flip properties? Yes.
No, it does not apply to fix and flip property. If you buy a piece of property to fix it up and flip it, what you did was you bought inventory. Inventory is something that you buy with the intent to resell. The IRS is adamant that when you buy that replacement property, your intent must be to treat it as an investment and use it as an investment.
Yeah.
On the street, we'll say, yeah, but if I can buy something for $100,000 and put 20,000 into it and sell it for 150, that's an investment. No, that's a business.
Right. Okay. The next one is Chase is asking, so the replacement property needs to have equity in it, meaning I cannot have 80% LTV in the house I'm living and purchase a replacement with 95% LTV.
You can have higher LTV in the new than you have in the old, but you have to make sure that as part of your 1031 exchange, all of the equity from the first property rolled into the new property. And if you want to increase your LTV like that, you're probably going to end up wanting to buy multiple properties because you need to spend all of the cash. Remember, Harry sold for 600, netted 560. He can leverage that 560 all he wants, but he has to spend the 560. If he can get $4.5 million in debt with his 560 in cash, God bless him.
Okay. Ross is asking, can a commercial rental property, for example, medical office building, be exchanged under 1031?
Yes, Russ, a medical office building, a traditional office building, a McDonald's, a ground lease. If you own the real estate, you can do a 1031 exchange. The asset class does not matter.
Okay. Jacob is asking, if I'm doing a 1031 exchange, am I forced to use all the proceeds from the sale? And let's say I want to still have some cash on hand. Can I keep, say, 10,000 from the proceeds out of the 1031 exchange and pay capital gains on the 10,000?
Yes, that's a very good question. If you choose to keep $10,000 out, you will pay tax on that $10,000. Over the years, I've seen a handful of people, not more than a handful, it is more than a handful of people very intentionally say, I want to keep 10,000, 50,000, whatever out. And that's fine. You'll have to pay taxes on that money come April. But that's okay. If you're willing to do that, that's legal.
Okay, that's all the questions I had.
Wonderful.
So you want to keep going and then we can do another round?
Excellent. We'll keep
Okay.
going. And if we didn't get to your question now, Carolina knows where we left off. We'll pick the rest of them up at the end. I think I've got plenty of time to finish what we're going to talk about. All right. So let's go beyond some of the basics and talk about some more detail. The taxpayer who starts a 1031 exchange needs to be the same taxpayer who completes the 1031 exchange. So on our example, Harry sold the relinquished property. Harry should buy the replacement property. But Harry can also buy that replacement property in an LLC if he is the sole member of that LLC. Now, some of you may live in a community property state and the rules are going to be a little different for you. But where Carolina is sitting right now, where Russ is sitting right now, where I'm sitting right now, I can tell you the three of us are not in community property states. So if Harry sells as Harry, Harry needs to buy either as Harry or as the Harry LLC. If Harry sells and Harry and Sally buy the property, that becomes a potential problem because Sally didn't own the relinquished property. Now, Harry sold for $600, his net was $560. If he buys a property, I'm going to use nice round numbers, double 560 becomes 1,120,000. If he buys a property that's 1,120,000, then he can buy half and Sally can buy half, and that's okay because we're able to trace Harry's value into the new property. Periodically, we have situations like this, and Sally's percentage is usually like 5 or 10%, and Sally has to be on there because she has better credit than Harry has. Go figure that the wife has better credit than the husband. So to get a traditional loan, they need Sally on the mortgage, and the only way that's going to happen is if Sally is also on title, and the lender doesn't care how much interest she has on title, but she has to be on title. So 560 plus another 56 becomes $616,000, I think is right. So as long as if they buy something that's $620,000 and Sally owns a 5% interest or a 10% interest, then that's okay. But they should not buy in the Harry and Sally LLC because that's a new taxpayer. This also does not apply to vacation homes. Now, on their face, it does not apply to vacation homes. The picture here on the bottom left, I know exactly where that property is in New Jersey. If you ever come up to visit, I'd be happy to take you to visit it. That family bought 3 adjoining houses, knocked them down to build this. And at least 2 of the houses that they bought were gorgeous. So I can only imagine what this was costing them all in. In any event, if I use this property exclusively as an investment, as a second home or a vacation home, it does not qualify for 1031 exchange treatment. However, if I use this property, there's a revenue procedure called 2008-16, and the revenue procedure says that if I rent the property for a minimum of 14 days per year for each of the preceding 2 years or each of the next 2 years, if I rent it for a minimum of 14 days and I limit my use to either 14 days or 10% of the time it was rented, whichever is greater, that qualifies. So a safe harbor essentially is a procedure that the IRS says, if you follow this, we won't challenge you. But if you deviate, you're going to get wet and we're going to figure it out. So the bottom line is you probably should not think of using 1031 exchange on your vacation home or your second or your third home if you are so lucky to have that many. Let's also talk again about 1031 exchanges as an estate planning tool. But the transaction I talk about the most is the one that I had very early on in my career. Grandpa owned a shopping center that had appreciated significantly. And he was speaking with a new estate planning attorney because his original attorney had retired. And he told the attorney, look, my 4 grandchildren are going to inherit the property. The estate planning attorney said, that's not a good idea. You should probably sell the shopping center and buy 4 of something else. So Grandpa did sell the shopping center. He bought 4 identical condo units, literally within walking distance of the main gate of a D1 university. He bought student housing for the graduate students at that university. Harry also could have bought into a tenant in common or Delaware statutory trust opportunity. We'll be talking more about that in a minute or two. Grandpa could also have decided to buy assets that were geographically more convenient to each of the respective grandchildren who would be inheriting the property. There's also reverse exchanges. Reverse exchanges are not about going back in time and saying, hey, David, I bought a property last week. Can I use that as part of a sale that I'm going to do next week? It doesn't work that way. So most of what we've talked about so far contemplate that we're going to sell first and buy second. And in a reverse exchange, you're going to buy first and sell second. But as you might imagine, there's a revenue procedure for that. And the revenue procedure says you can't own both properties at the same time. So what's going to happen is the intermediary will form an LLC, typically to take title to that new property on your behalf. You will lend the money to the intermediary to buy that property on your behalf. The intermediary will now lease it to you on a handshake saying, okay, Carolina, this is your property. You have to manage it. You're going to hire the landscapers and you're going to collect the rents and you're going to do all of those other things. In the meantime, Carolina is going to continue to market her old property. And when she sells that property, we will structure that sale as part of a traditional 1031 exchange. All of the same documentation. The proceeds will flow to me as they typically would have. But wait, instead of dispersing the proceeds to pay for new property, we already have the new property. I borrowed money from Carolina, so I have to pay that money back to Carolina. And I also have to give her her new property. If she's able to sell the old property within the 180 days, she has done so within a properly structured reverse 1031 exchange. If she gets to day 180 and it hasn't sold, she can pull it off the market. There's no taxable event. She now owns 2 properties instead of 1, which may be a different headache that she didn't want to have to deal with. Or she could continue to market that property and sell it as part of another 1031 exchange, but it won't be part of the reverse 1031 exchange. Now, we can take this a step further, and one of the questions earlier talked about, can I pull some money out? What if I buy a piece of property and it's not worth as much as the one I sold, but I can do some rehab to it before I expose it to the rental market? So I think these 2 pictures, or 2 sets of pictures, pretty well illustrate that. If I sold my first property for $560 and I bought that rancher on the left for $400, I'm short $160,000. If I can get these improvements done within my 180-day window, so on the left, it's a new siding, new roof, a dormer over the garage. We changed the windows, we changed the doors, probably upgraded the kitchen and the bathrooms. If I can get all of that done within my 180-day window, I can do it. And what's going to happen is I sold my $600,000 property. The qualified intermediary is going to use my money to buy the new one. The same thing with the LLC. The LLC will buy the new property. Let's call it New Property LLC. Carolina is going to be the construction manager. She's going to hire the roofer, the cider, the window guy, the kitchen guy, the bathroom guy. They'll all do all of their work. And as each one submits invoices, Carolina will sign off. We'll wire money to pay off the invoice. And when all that work is done, Carolina will say, David, it's all done. And we will transfer the property to her either by deed or by transferring the LLC, depending on a variety of factors. Sometimes it's better to transfer the deed. Sometimes it's better to transfer the LLC. We will make sure from the beginning that we know which one we're going to do, which one is best for Carolina. This works. It happens a lot. It happened an awful lot during COVID because people wanted to buy property early. So they would buy the property before they sold their old one, but the one that they're buying isn't worth what their old one was because a lot of you do a lot of rehab work. So we were doing a lot of this kind of transaction during COVID. Okay. Another question that comes up is, well, wait a minute. Somebody was asking about having a higher LTV. What if Harry says, you know what, I sold this one for 560, it's all cash. I'm going to buy my new one for 600,000 all cash, and then afterwards I'm going to strip out equity and go buy additional properties. That's okay. You can refinance the replacement property after closing without a headache. You do not want to refinance the sale property before closing. That will cause a headache with the IRS. But you can take that new property, you can combine your 1031 exchange with a BRRRR, so you could buy your replacement property. You're not necessarily going to have to do any rehab work to it, but you can strip out equity, you can refinance it, reinvest it, and go on and do the next same thing all over again. What about multiple properties? Carolina can sell 2 properties to buy 3. She can sell 3 to buy 2. That works fine. If that's part of the plan, we want to talk early about this because it may be in your best interest to set this up as multiple 1031 exchanges, depending on the timing, or it may be prudent to set it up as all one exchange. Generally speaking, if you're selling multiple properties to buy one, probably in your best interest to set it up as multiple exchanges, as one exchange. But if you're planning to sell multiple and buy multiple, there are some significant reasons why it may be in your best interest to set this up as multiple transactions, because those identification rules will now apply to each individual transaction rather than to one larger transaction. Again, we will chat with you early and often to make sure we set it up the way that is best for you. All right, now let's go beyond the beyond and talk about some strategies for folks who are starting to near the end of their investment career and starting to want to wind down a little bit, maybe be a little more hands-off. So I could sell my apartment building and I could buy a triple net asset like a Walgreens or a Tractor Supply. These are great opportunities. What's wonderful here is that Walgreens and Tractor Supply and Dollar General and FedEx and the like tend not to move very often. Once they are in place, they tend to stay there for a significant period of time. The properties are often purpose-built, so if Walgreens chooses not to renew at the end of a lease cycle, you may have a difficult time getting a new tenant in, maybe not. But it's certainly something worth considering because it's literally about as close to management-free real estate as it gets. Some of these properties are a little expensive, so perhaps sometimes they are not just triple net for you, but perhaps I partnered up with Russ and Carolina, and candidly, the brokers who sell these might have matched my money up with somebody who I don't even know, and I don't care because we're not making any management decisions. Either Walgreens is renewing their lease or they're not. They're paying their rent. I'm not worrying about it. So there's something to consider. Tenants in common, which I just kind of alluded to, was approved by the IRS for 1031 exchanges back in 2002. And this is a wonderful opportunity where 35 of us on this call could pool our resources and buy one large, really large asset, certainly something larger than we would have been able to buy on our own. I know what I can buy. I know what you can buy. I know what Jim can buy, what Hannah can buy. But if we combine our assets, think about what we could buy together. Generally speaking, a larger asset is probably going to have higher cash flow. The problem with the tenants in common strategy is that we have to have pro rata voting rights. So if Carolina put in $200,000 and I put in $100,000, she gets 2 votes for every one of mine. And to make matters worse, we need to vote unanimously on every management decision. So renewing leases, changing rent rates, hiring a property manager, all has to be unanimous. I suspect if Carolina said she's buying pizza, we all have to choose a topping right now, no questions asked. We would not all pick the same topping. Okay, so tenants in common works best when you have a small group of people and they all know one another. But as a general rule for larger investments, it's been replaced by the idea of a Delaware statutory trust. Delaware statutory trusts were approved by the IRS in 2004. And here we're talking about some really, really large assets. Not always, but you may be aware of this little company called ESPN. Well, a few years back, ESPN did a sale leaseback with their corporate headquarters, and the purchase was structured as a Delaware statutory trust. Some of my clients bought into that investment, and their ownership shares were measured out to 7 decimal places. So 0.1234567% interest in ESPN's corporate headquarters up in Connecticut. Sometimes they're multi-property portfolio assets, so you further diversify. Sometimes they are single assets. Sometimes they are, when they're multiple assets, when they're portfolio assets, sometimes they're grouped by asset class. So maybe it's 8 retail properties across 4 states, or 6 office buildings in the Dallas metro, that kind of a thing. It's something worth considering, especially if you're wanting, for whatever reason, a little bit of hands-off time. Coming down the home stretch, we also have oil and gas royalties. For folks like me up in the Northeast, people have no idea where oil and gas comes from other than that pump at the Costco. But for folks in Oklahoma, Mississippi, Tennessee, Texas, you drive down the roads, you're seeing wells. You can buy oil and gas royalty interests. You're not investing in the mining operation. You're not investing in the exploration. You're investing in the residual income. When Exxon pumps out a barrel of oil, you get a whatever percent interest in that barrel of oil. There are 37 states that have operating oil and gas wells. And as you might have imagined, Texas, Kansas, and Oklahoma are number 3. Oh, 1, 2, and 3. Real quick, as we're winding down, I mentioned earlier, there are some budget issues going on. President Biden's budget proposal says that he wants to close the so-called like-kind exchange loophole. Section 1031 is not a loophole, it's a statute. It's been in the book since 1921. It encourages investments. The Democratic National Party platform for this election cycle also wants to eliminate the like-kind exchange loophole. And I'm not telling you this because I want you to change your vote from red to blue to purple to pink to paisley or whatever. I'm simply wanting you to know that there are some potential attacks on 1031 exchange looming. Section 1031 stimulates transactions. It stimulates the economy. If you have any interest in preserving 1031 exchanges, I encourage you to go to that website, 1031buildsamerica.org. I don't get a penny from you going there, but you can type in your zip code and the website will populate a letter, an email to your representatives in Washington so that you can let them know that you think Section 1031 needs to be preserved. And that brings us to some time for some questions. And I'm going to stop on this slide here and say 2 things real quick before we open it up for questions. One, there's my contact information. Feel free to call me, email me. If you liked this presentation, please use that Google code there and give me a 5-star review. If you didn't like this presentation, please call me tomorrow and tell me why. And I'd be happy to try to make it better next time. Carolina, let's have some questions.
Okay, we have a few more questions. Okay. Okay, Jacob is asking, if I'm doing a 1031 exchange, am I forced to use, oh no, I read this one, never mind. Okay, Hannah. This one is cool. Could I exchange for a rental property in a college town where my child is one of the tenants of the rental property?
Over the years, I've had a handful of clients do this. The first one, the gentleman's daughter declared in her freshman year of high school that she was going to go to the University of Miami. So he sold property here in New Jersey and he bought a condo not far from the University of Miami. And lo and behold, 4 years later, that's where she was going. And as you might imagine, Daddy funded her bank account at the beginning of the year. And there was a real lease between her and her roommates. And they each wrote a check each month for the rent. Yes, you can do it, but you should have a real lease, real fair market value lease. We can talk about perhaps some adjustments on that because your kid's going to be there to manage the property. But your kid should write a check. You should deposit the check in your business account every month. Treat it like a real tenant.
Okay, the next question from John De La Cruz. I just want to clarify, you mentioned you can't use a 1031 exchange for fix and flips, but they are allowed to use that for buy and hold rental properties?
Correct. Fix and flips, no. Buy and hold, yes. Buy, fix, and hold, yes. But fix and flip, no.
Juan is asking, can Harry sell in Harry's name and right away quit claim title to Harry and Sally's XYZ LLC? Juan, great question.
Okay. So I'm going to give you a couple of answers to this one. So if Harry sells and then Harry buys and Sally wants to be on title, most tax advisors would say that Harry should leave it in just his name for at least 2 years. There's nothing in the code that says that, but 2 years is people are using 2 years for a lot of reasons. Let's call it seasoning, right? If you chop down an oak tree, you're not going to put it in the fireplace this year. You're going to let it season for a couple of years, right? Same thing with the 1031 exchange. You're going to want to let it season in Harry's name for a couple of years. Could he then add Sally's name? So quit claim from Harry to Harry and Sally? Absolutely. If he quit claims from Harry to Harry and Sally LLC, unless they live in a community property state, that LLC is a partnership. It's a new taxpayer. So that would have tax ramifications transferring it from Harry to the partnership. He could do that probably using Section 721, but if he called me and asked me that question as part of an ongoing 1031 exchange, I would say to him this, Harry, you might be able to get this done using Section 10721 and use the asset as your contribution into the partnership, but you should double check with your CPA to make sure that there's not something I'm missing.
Awesome. Okay. Jesse is asking, after multiple 1031 exchanges, can I move in one of the properties after it has been rented out for at least 2 years?
I'm going to give you a definite maybe on that. Right? If your plan when you bought the property was to move into it, and the IRS finds out that that was your plan, they could deny your 1031 exchange retroactively. But if your plans change, so I have one of my properties is a 1-floor condo. It's a ground floor condo. You have from the street, from the parking space to the front door, you walk up 2 steps. If something happened to me where I no longer wanted to walk up the steps in my traditional single family home, I could tell my tenant that I'm not renewing her lease and I could move in. But my plans changed. That wasn't part of my original plan. Now, I am certainly aware of people who say, again, I'm in New Jersey, you know, I think sometime in the next 10 or 15 years, I might want to retire down to Florida. So I call Carolina and I ask her to help me find a wonderful property in her neighborhood. And I buy a wonderful property near there and I rent it out. And I rent it out and I rent it out and I rent it out. And I wake up one cold February day in New Jersey and I'm frostbitten walking from my car into Costco and I say I'm moving down to New Florida. And I tell my tenant down there, I'm not renewing your lease. And when they move out, I move in. That's different, right? I didn't plan for it. I kind of sort of planned for it. I didn't put a date on it. I knew that eventually. Again, bottom line, that taxpayer comes to me with that question, I'm going to suggest that they talk to their CPA to make sure that the CPA is okay with it, because ultimately the CPA is signing your tax return along with you.
Okay. The next question is from Jacob. You mentioned a 1031 exchange will cost around $1,300. How much would a reverse exchange cost?
Good question. So a traditional simple forward exchange is going to start at around 1,100. Again, 10% discount for the RIA folks. A reverse exchange is going to add to that, starting at about $5,000 or $6,000, and depending on the complexity, if there are improvements being made, if there are lenders involved, excuse me. But you can assume that you're going to add $5,000 or $6,000 or more. I'll tell you a to the penny fee in advance if you tell me all the facts. But a reverse exchange is going to add a minimum of $5,000 or $6,000. I had a transaction a bunch of years ago where the taxpayer was buying waterfront property in Florida that the prior owner had underdeveloped, and he was going to take this property and turn it into a true marina. And he was going to build a bait shop over here and a gift shop over there, and he was going to extend the dock and put in fuel pumps. And I quoted him a $40,000 fee for that transaction. He said, okay. And he said, okay, so fast. I said, damn, I should have charged him 50.
Okay. Ross is asking, could the current DNC proposal to tax unrealized capital gains at 25% affect 1031 exchanges if it were enacted?
So anytime government plays with taxes, it's likely to have some impact on 1031 exchanges. Taxing the unrealized gains wouldn't necessarily have a direct impact on 1031 exchanges. And as I recall, that proposal applied only to folks over a very high threshold, several $1 million, if I'm not mistaken. So I don't think it will affect any of us. I mean, if it does affect somebody on this call, I'd like to become your new best friend and learn from what you're doing. It may have some residual trickle-down effects, but I don't see it having a direct effect on most of us.
Okay, Christy's asking, so if I'm planning to fix and hold, then I set up a 1031 when I'm buying the property or when I refinance the property?
The 1031 exchange needs to be set up before the first transaction in the string. So in a 1031 exchange, there's going to be a sale and a purchase. If we're going to sell first and then buy and do some fixing, we want to set up the 1031 exchange before we sell. If we're going to buy first and do some fixing and then sell, we want to set up the 1031 exchange before we buy.
And following that, because somebody has had sent me a question on the private chat. If, let's say they buy a property today, an investment property, they start renting it out, is it considered after 1 year? Is that okay? Like, is that okay? Is that a season enough to say, okay, I'm going to sell my investment and then roll it into a 1031?
Oh, yeah, there is no minimum holding period if you're going to do another 1031 exchange.
Okay.
There are some documented cases where people have held property for less than a year and done a 1031 exchange. There are also some documented cases where folks held a property for more than a couple of years and their 1031 exchange was denied. It's all a matter of, did you properly structure the transaction? Here's the problem that comes up a lot. Somebody will have a property that they say is a rental property, but they don't actually declare the income on their tax return. So if the property doesn't show up on Schedule E of your income tax return, and now you want to do a 1031 exchange on that property, the IRS computer is going to set off all kinds of bells and whistles saying no. So make sure you treated the property properly before we structured the 1031 exchange.
Okay, we have two more questions. I think we're almost out of time. Jay, I think David already answered the Canadian part of this. If you are right, if you're U.S. taxpayers, then that applies to U.S. taxpayers. But if you're a Canadian taxpayer, then
a Canadian who owns U.S. investment property would benefit if they do a 1031 exchange with their U.S. investment property. But if the Canadian is doing everything in Canada, I can't help with Canada tax law.
awesome. And the last question from Jacob is, let's say I buy a house for $50,000, put $30,000 worth of repairs and sell it for $150,000. Will I get hit with capital gains on the difference between the two purchase amounts, $50,000 and $150,000, or between my all-in of $80,000 and the sales price of $150,000?
It would be the difference between your all-in, so it's your adjusted basis, which is purchase price plus improvements, right? But also keep in mind, if this all takes place in less than 1 full year, it's short-term capital gain, which means it's ordinary income. So, one more reason why I don't like the fix and flip model. I know a lot of people who do fix and flips as their primary source of income, and God bless them, they're doing very well and they enjoy it, and that's phenomenal. I'm very happy for them. Not me. Not me.
Because we know we're ready. It's like, okay, I know I did a flip, but I know I'm gonna pay this amount in taxes. Like, that's why you do your flips. And
look, I know
your self-directed IRAs.
Look, we're talking about a fix and flip, and you're going to make all of these improvements. I had to go fix an outside hose faucet on a rental property over the weekend. That's a tiny little repair. I'm not hiring somebody to go take care of this tiny little repair. Except guess what? By the time I took the hose apart, the faucet apart, the parts on the inside were damaged. I had to buy new ones. Well, Home Depot doesn't stock that part. Lowe's doesn't stock that part. Ace doesn't stock that part. True Value doesn't stock that part. And the plumbing supply place isn't open on the weekends. So guess what? I get to go back there again tomorrow after work and fix it again. If that's what's happening on a $12 part in a faucet, I can only imagine what's going to happen if I'm trying to do a fix and flip.
Like everything, if you know what you're doing and where you're getting into in and out, some deals are beautiful for flip in and out. Some deals are beautiful for rental. Some deals are beautiful to do in your self-directed Roth IRA, and some deals are beautiful to do a 1031 exchange. Okay, I put David's contact information on the chat, so I am sure you're gonna get hit with tons of emails and calls very soon, David. And thank you so much for being here. I'm getting all these amazing compliments from our attendees. So thank you, David. I think now they are knowledgeable in 1031 exchange. The ones that have never heard of it, now they know.
I thank you all for taking time out of your day. Please feel free to reach out with questions that may come up. I'm here for you. I don't charge for consultations, and I'll give you a discount if you set up an exchange. Awesome. And if you're in Sarasota or Fairfax, go to one of the Traction events. I'll be at the Traction event.
Oh yeah, you're coming to DC September 19th. You're
Yeah,
gonna come and have beer with us. So
absolutely.
if our DC crowd, if you want to meet David in person, he'll be there. So he'll be answering questions and having beer with us and then working. So that's fantastic. And I hope you feel better, David.
I'll be fine.
I feel you'll recover very, very soon. And thank you again. Juan, the date for DC is September 19th at the same location on the Caboose beer, blanking out. The Caboose beer thing in Fairfax, but it's on our website, but it's September 19th and I'll be there. So thank you again, David, and get well. And thank you everybody for attending. Any questions, you have David's contact info, and have a good night.
Thank you all.